cowboy developers out there these days, right? When you talk about private debt or non-bank lending, there is always this stereotype of developers that, these are loan sharks. If you're wasting like 6 months of interest rate while getting your loan approved, that's wasted money. How far is private debt compared to some of these major banks? Because some of these mid-tier banks are still playing in this space. Has there ever been instance for you where you are 70-75% in completion and the builder goes bankrupt? You're eating away your profits, right? As a developer, me myself, I always tend to think like the speed matters a lot more than the rate. Co-living properties can generate almost $140,000 in passive income and net of $40,000 in passive income after mortgage repayments, and they sit in an average yield of about 10%. Hello and welcome to another episode of Help Me Buy Property podcast. Today on the podcast, I have someone that I think I have been waiting to talk to for a very long time. This is someone directly from private debt, Mr. Matt Crowe from Bowery Capital. He's the CFO of Bowery Capital. Now we're going to talk and open up the discussion about how does private debt works, what options do private debt offers to the investors and the developers. And we're going to also talk about how does this fit into your property investment lifecycle. So join in introducing, drum rolls, to Matt. Matt, how are you today?
Very well, Mus. Thanks for having me on the show.
Thank you very much for coming through. For viewers and listeners, let's start through what is private debt? Like, what does it really mean?
Yeah, so private debt or private credit is sometimes called, or mortgage fund investing, mortgage secured investing. They're all essentially the same thing.
Yeah.
They're investments where you are secured by a first mortgage. So that you're secured by a property. The investment manager, in our case Bowery Capital, has a mortgage over that property, and that is what secures your investment. So it's quite different to, say, listed equities where you don't really have security. We have, in our investments, we are secured by a property that sits behind your investment. And that's, I suppose, the defining characteristic of private debt.
Yeah. And when you go around talking to non-bank lending, because that's the favorite term that a lot of developers for viewers like, non-bank lending or non-bank lenders, how does a non-bank lender define their risk appetite? Like, how do they choose what fund to invest in or what projects to invest in?
Well, there's quite a range of risk appetites in the non-bank lending space, and we're probably more on the more conservative side. There are some who are much more willing to take on risk. It's really a decision for the individual businesses.
Yeah.
But I guess what they all have in common is that we fund a range of transactions that banks typically don't fund. And that's anything to do with construction and property development. For various reasons, banks don't like to fund property development.
Yeah.
The way they're regulated makes it quite difficult.
Yeah.
And so we've seen this trend in the Australian market, which is really following what is happening overseas, so that a bigger and bigger proportion of property lending is now being done by non-bank lenders. In countries like America, that's more than half of property-related lending is done by non-banks. Yeah, where Australia has traditionally, the big four banks have had a vice-like grip over lending of all sorts, but we're now starting to go the way other countries are, where you're having a very vibrant and competitive non-bank lending sector. And that's great for developers because it gives them an expertise where they're dealing with people. But it's also great for investors because it's no longer the banks who are funding this. It's businesses like us, and we're offering those investments to investors and to add to their portfolio, which is a really exciting development over the last 15 years.
And look, and I'm going to be candid here, right? When you talk about private debt or non-bank lending, there is always this stereotype with developers that, these are loan sharks, and be very wary of them. They'll hook you on to, crazy contracts. And you hear a lot of sad sob stories around this, right?
Yeah, and I think because Australia's been so dominated by the banks for so long that we've tended to view anyone who's a lender who isn't a bank as a bit of a loan shark or a payday lender.
Yes.
But the truth is there is a very sophisticated sector of the lending industry that's funding an enormous amount of development throughout the country. And what it really offers is an expertise in property development, because banks don't really have an internal expertise. A typical bank mortgage, it's against a house. All they really want to know is how much money do you make and can you afford the interest?
Correct.
And that's really all they need to know. They don't have the appetite or the capability to look at a property developer and say, well, will this work?
Yeah.
Is this something that we're prepared to fund? But they might for a $100 million development. That's in their space.
It's big.
But for a $10 million development, no, it's just too much trouble. It doesn't really suit their business model. So we're just seeing more and more sophistication coming into the private debt market. I mean, in the past, these businesses were really run out of law firms because the law firms were very good at producing the mortgage documents.
Correct.
But they weren't really proper businesses. They were a series of transactions that came out of the legal industry. And we're now seeing that proper businesses forming, and any of which have been around for 30 years, and some have been like us for 5 or 6, starting to offer really competitive products to property developers so that they can undertake the developments that they've got planned.
And how does it works and helps the developer in this space? Because of course, there are still banks like NAB who has a big risk appetite when it comes to, 3 or 4 type townhouses. Of course, 10, 15 million is not something that they would play in, but then you see a lot of material lending coming in through Latrobe, your likes of Latrobe and Liberty and even Granite, these days, where they're trying to enter into this space versus non-bank lending like yourself. How does it help the developer? What
just gives them more choice. It's a very competitive market, and the combination of a good mortgage broker who will shop around and get his client, who is the developer, the best deal. The best deal is not always the cheapest rate. It's really the expertise that that you're dealing with someone who understands the property development process.
Yeah.
And you'd be really surprised. We have borrowers who have balance sheets of hundreds of millions of dollars who don't deal with banks because they want to deal with someone who understands what they do for a living.
And property development.
And someone who can act quite quickly. Banks tend to be very slow to.
Yes.
If getting out of a house mortgage is quite quick, but if you want to fund a project, it can literally take years to get approval. Now, that's not really a viable model for a property developer. In that time, that developer might have funded 2 or 3 projects with a non-bank lender because they understand the nature of the development. They understand the risk. They've probably funded 20 projects that are very similar, and it's just a much smoother process.
I think I completely agree. I think when you talk about interest rates versus time, right? If you're wasting like 6 months of interest rate while getting your loan approved while it's construction ready, that's wasted money.
That will ultimately destroy your development if it's just sitting there forever and not do anything. And
you're eating away your profits, right?
Yeah,
as a developer, myself, I always tend to think like the speed matters a lot more than the rate that I'm going to pay now. So I'm happy to pay an extra 1 to 2% for me to bring the product out to the market a lot more faster and quicker, because I might miss the market, right? A lot of
and the other big difference is that banks really lend against income. So property developers have very lumpy income. They might not make anything until their development's finished and they sell it and they have a big payday. Now, that's not the profile that a bank really wants to lend against. Non-bank lenders, on the other hand, lend against the asset, and it's the value of the asset rather than the income. So one big difference with a loan from a non-bank lender or a private debt provider is the borrower doesn't service the interest the way you would in a traditional mortgage.
Yeah.
The interest is included in the amount that's advanced. It's held by us and we release it to the investors every month, but the borrower doesn't have to service monthly interest because he's already capitalized it in the loan. And that is a much better match for a property developer who are often asset rich but income poor because all their equity is in their project.
So true.
It's just a model that better suits a developer than what banks offer.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
I think as a developer that I always say this to my team that, as a developer, you always see more red than green on your profit and loss, right? You see a few lines of green and majority of that is red because you have your expenses going up.
It's the nature of property development.
Correct. And so it makes total sense from a development's perspective to run with pace, and it's risk versus reward, right? If you are paying a slightly higher interest rate, that's okay, provided that, you get the speed of, the funds and you move with pace as well.
And the other benefit for a developer is that probably a couple of years in the life of a developing asset where they would be using a lender like us, once their project's finished and perhaps fully leased, and they might then go to a bank and get significantly cheaper debt. But it might just be for that 2-year period while it's pre-development and being built and then being leased that they're dealing with a specialist lender who really understands that process, might charge a little bit more, but at the end, they can then go on to a traditional form of debt.
How far is private debt compared to some of these major banks? Because, some of these mid-tier banks are still playing in this space. When you talk about, the rate to offer to developers, how far are you guys from the deals that you guys offer?
Oh, look, we are more expensive than a bank.
Jobs.
Yeah. But then there's other things to take into account. Sometimes the level of gearing might be slightly higher because if we feel we're comfortable and we understand that, we'd be prepared to lend on a higher LVR than say a bank would who just say, I'm not sure, so they just make it really low.
Yeah. How high have you done that?
Typically, we do about 65% is and it varies whether on the type of asset, so and the lender, and also what you find when asset prices are increasing, LVRs also increase.
Yes, of course.
And similarly, when prices are there's a bit of downward pressure, you see LVRs tend to come up and down with the market a bit because no one wants to get too high. But say on construction, we typically have a lower LVR because it's a more complex development. If it's just a building that had been purchased, that's going to be a future site, we maybe we'd go to 70%, but
Yeah.
we're pretty comfortable around that 60 to 70% LVR.
And it's interesting also is that, I see, a lot of private debt offers, really low LVRs on land deals versus construction finance. And so if you go pure plain land where there is no DA available, you would go like 40, 50% LVR.
That's right, because it's a different type of asset, and selling a piece of land that's not yet been approved, it's a less liquid asset. So you would
and it's always risk as well, right?
It's harder to sell.
Yeah.
There's a smaller pool of buyers for an asset like that. So you would often see LVRs in the low 50s for deals like that.
Developers are really cheeky as well, right? So, when they go out there and talk to you, of course, you might offer an LVR of say 65%, but then they reach out to other people and raise mezzanine debt to basically take them to 80% because they might have 15 or 10% or even 0% in some cases of their own money into some of these deals, right?
Well, there's a lot of lending options out there. So, and it's a very competitive market. So brokers, they shop around, but good brokers know that you want to partner with someone who understands your business needs. And that's probably more valuable than half a percentage point on an interest rate but typically, developers, they want to put in as little money as possible.
Yes, 100%.
And they want
maximum
us to put in as much as possible. And that's just part of the commercial negotiation that we need to have we like to see developers who have plenty of equity, plenty of skin in the game. That way we know they're fully engaged and our investors like that as well. If our RVRs were too high, we just couldn't get our investors to buy into it. So it's very much
there's a lot of cowboy developers out there these days, right? Every Tom, Dick, and Harry that I talk to is either a developer or is is aiming to become a developer, and they don't, like I always say this, development is a game of finance and structures. You work these two out, and the feasibility is strong enough, you'll see the end through, right? And it needs to work on paper before you actually go out and do it.
Absolutely. The amount of time that goes, some of the developments we fund, it could be 3 or 4 months of due diligence before we get to a position where we're saying, right, yep, we're happy to proceed here and we're happy to take it to our investors, because a lot of the time the deal, by the time it's funded, looks very different to how it might have looked when it first came to us.
Yes.
So that's the importance of having internal capability who can say, no, that's not the best way to do this. Rather than just say, no, we say, but this is how you could do it. And then we can get it into a shape where we can take it to our investors, and it's a compelling offer.
Yeah.
We also value experience. So while there are a lot of first-time developers, we tend to look for people who have a good track record, who have developed similar projects in the past, and that's really the kind of developer we're looking for.
Amazing. Now let's change gears. Let's talk from the other side of the story, the other side of the fence, which is the investor's lens. And so, of course, for you to give out money, you need a lot of investors. And so talk us a bit, for the viewers and listeners, talk us a bit about how does that side of the things work? What do you offer to the investors who are co-joining in, offering this money to the developers?
So the investor opportunity is really what's grown in non-bank lending of recent times. There's always been people out there lending to developers, but it's starting to become an investment product that's more and more widespread. Wherever you go to a investment seminar, private debt increasingly talked about. We find it's particularly popular with yield investors or income investors who might have had money in the stock market in higher yielding stocks like utilities and toll roads and so forth, or they might come from traditional property owners who are landlords and they're earning 3 or 4% property yield, but they can get twice as much as that and not have all the hassles that come with being a landlord, and that can be considerable, by investing in a mortgage. And so most of our investors come from those areas. We have investors who have been investing in this sort of product for 30 years. We have others who have come very recently who might have been in fixed-term deposits, particularly when interest rates were falling, just finding that they were getting 6%, then they're getting 2%, and that's just not enough. So started to look at alternative investments. And so we offer to the investor, firstly, the security of a mortgage. That for every investment we do, we have a registered first mortgage. And that's a really powerful form of security. It means you have ultimately the right to sell the property as mortgagee in possession if you should need to. That's a very powerful right. It doesn't matter. No one can get in front of you. No one gets paid before you under a mortgagee in possession. Not the tax department. Any caveat holders, they all drop away if and when we had to sell a property. So that's a very powerful security that this industry couldn't exist without it. The other thing investors like is the regularity of income, and that you're not so you're getting monthly interest, and when the loan is over, the principal is repaid, and then we look to give you another similar investment. I suppose a lot of people compare it to investing via the stock market, and that's my background within the stock market. And stock market's a great way to grow wealth. It's not a great way to generate income. It's expensive. The yields are relatively low. Like a good yield on an invested product might be 5, 6, 7%. We would, in a private credit or a mortgage product, 9 to 10%. And that's without the volatility of that you associate with stock market. So we find a lot of people, and what we say is, if you've got a portfolio and you're wanting to grow it, stock markets allocate a certain amount for growth, and that's what use the market for that. But if you're trying to generate income, you can generate the same amount of income with less capital tied up through private debt products than through equity products, and that just leaves you more capital to pursue growth. And the main difference, I suppose, the disadvantage is that it's not as liquid as the stock market. You can't sell it at any day. Our loans are normally 12 months, and you are putting the money away for that period of time. But what we find, a lot of investors will have multiple loans, investments at the same time. They might have $500,000 invested over 5 different investments of $100,000 each. And they're staggered through the year. So they've always got something coming up fairly soon. And that solves that liquidity problem.
And how small or large does the investor needs to be? Is there a minimum buy-in?
So the minimum investment's $50,000. It's no maximum. You can invest as much as you want. It's really just limited by the size of the deal.
What's the maximum that you've seen coming through?
I think our biggest single investment, probably $5 million for an individual. That's pretty rare. 100 to 200 is fairly normal, but a lot of people invest 50, and a lot of people will invest 50, as I said, over 10 different facilities to have that diversified portfolio and always having something turn over. So there's quite a range.
And where do these investors? Where do you find them?
Well, mostly through referrals. We have really grown by word of mouth. It's amazing when someone has a good experience, they tell their friends. And really started by recruiting investors through people we knew and business associates and so on. And it grew from that. We do occasionally target people like accounting officers who might want to offer a certain investment to their clients. And we're starting to talk to family offices, but the growth we've gone from 0 to about $300 million under management has almost entirely come from referrals.
And do you need a financial advice license or an AFSL?
So we have an AFSL, and our Australian Financial Services license allows us to deal with sophisticated investors. So we don't have a retail license, and some non-bank lenders do. But so to be an investor with Bowery, you need to have net assets of $2.5 million or have generated income of $250,000 per year 2 years in a row. That's to meet the definition of a sophisticated investor, and that's who we deal with.
there's a lot of mom and dad investors out there who are basically trying their luck into a lot of this space as well. And I see them losing a lot of money, not in the private debt space, but more in the mezzanine debt space, right? It's always an interesting sort of mix as to where.
Yeah, so like mezzanine debt or second mortgages, it's sometimes called, significantly higher risk and return. We don't do them very often.
Is it significantly return? Like, I've seen mezzanine debt being offered at 18% or 17% versus what you're offering at 10%, right? So, like, in the bigger scheme of things, the amount of money that they're offering, that they're putting into mezzanine, I've seen people offer, putting in, $400,000 or $500,000 in there in order to chase that 15% return. Was like, for an extra 5% return, you're taking like 10 times more risk.
Yeah. So look, that's an individual's risk appetite. We don't offer many second mortgages. Occasionally we do. What we find, sometimes people will put a substantial amount into the first mortgage and a smaller amount into a second because they're just trying to enhance their return a bit. But our core product is 60 to 65% LVR first mortgage. That's where we're comfortable that's a good level of security. You get a great risk-adjusted return. Right. Beyond that, it's fewer people are interested in going on to those higher.
Let me ask a curveball question here. And I've never been able to ask this question to a private debt lender. While you guys do say that, okay, the asset, it's asset-backed investment, it's asset, but you are basically lending the money to a GRV, right? Which is a gross realized value, right? But the value might not be realized till the product is finished.
That's right.
And so the actual asset value is actually quite low, but then the lending against it would be quite significantly higher based on the future value of where it sits.
Yeah. So in a construction project, that's right. You're lending against the future value.
Yeah.
But you're not advancing all the money at the start. So at the start of a construction loan, you're just advancing against the land value.
Yeah.
It would be crazy to advance the full amount
at the same time.
Yeah, so because that security hasn't yet been built.
Yeah.
So the way that's done, and this is not unique to our business, it's pretty standard, is that you only advance the money
based on the QS and
when the work has been done. And you hear a lot of horror stories of people, builders going broke and lost their money. That happens because they pay their builder in advance. Well, mortgage funds or non-bank lenders never pay in advance. The builder has to fund a certain amount of build.
Yeah.
Quantity surveyor goes out and says, yes, it's been done.
Yeah.
And then we give them the money.
Yeah.
That way the security is becoming more valuable in advance of the funds being advanced to the borrower. And that way you're not in a situation where
you've overpaid,
where your loan is bigger than the value of the security.
And has there ever been instance for you where, you are 70-75% in completion and the builder goes bankrupt or builder goes broke?
We've had a builder go under. We have had projects change builder because they were not happy with the progress being made. So, but never actually one going broke. And we do checks beforehand that on not just the borrower's financial capability, but the builder's financial capability, because that's just as big a problem. If so, no, and we like to build in enough time that if you did have to change builders, and sometimes that happens, that there's enough time to do that and still deliver the project. But that's why construction projects are just more complex than non-construction loans. The majority of loans we do don't involve any construction.
Yeah.
You're just secured by a property that's valued as it is. It might be going to be a future construction site.
Yeah.
And perhaps we will fund that construction or someone else.
Yeah.
But for investors who are perhaps cautious about funding construction, there's plenty of opportunities that don't involve any construction, or they involve, say, land subdivision, which technically is a form of construction, but it's nowhere near as complicated.
Yeah.
If you something happened to build it, much easier to get another one. You don't even need a building license. It's a civil contractor. Yes. It's quite straightforward. And so there's a real range of risks through the products. And I guess what you find is as the projects become more complex, the hurdle to get the loan is higher. You need to have more experience. You need to have more balance sheet behind you in case something happened and you needed to put money in. So, certainly all loans are not the same.
Yeah.
And we have different hurdles that the borrower must get over depending on the nature of their project.
I see a lot of capital funds doing crowdfunding. I've seen some crowdfunding platforms basically coming into this space. And also another interesting one, which was quite recent, which hit my desk, was where a company was offering AFSL to a developer to raise their own funds, which is quite interesting. Like in this space where, you are basically, giving like a car that goes from 0 to 300 miles an hour to a person who is basically going to do an accident, right? Be the developer. I always find it quite interesting and quite interesting. And should I say, like in two boats where yes, you're solving a problem, but hey, you're creating a lot more risk for institutional investors or retail investors as well.
Yeah, I mean, AFSL, Australian Financial Services License, comes with pretty serious regulatory obligations, and we don't follow that model. We operate under our own license. There are many who operate under licenses that belong to other entities, but and similarly with investors, trust is a huge part of this industry. So our investors have had many successful investments. So the idea of sort of raising from or crowdsourcing from people you have no relationship with, I think that would be difficult. The relationships are just so critical, whether they be on the lending side or on the investing side, that I think a lot of people, once they've had a good experience, they like to repeat it. So that's also, vital to us.
It also comes down to like a lot of these capital funds that I see, they go down the path of using a pool model, right? So they have a pool of funds that they're giving everything to everyone. So everyone's money is in a pool and it's basically leveraged against everything that they're lending out to, right? So it's not, one-to-one relationship to it.
Yeah. So there's the word mortgage fund can mean two things. There's a pooled fund, which is what you're describing, where the fund might hold 12 properties and there's loans against all of them. And as an investor, you're earning the average of those 12. And when one deal goes out, another one comes in. So that's a pooled mortgage fund. Then there's what's called a contributory mortgage fund, which is what Bowery Capital currently is, where each individual transaction is separate and you're investing in just that one transaction secured by that one or maybe two properties, but it's one mortgage. You choose what you want to invest in. You don't have to worry that there's something in this pool that maybe you're not sure about. If you don't like something about that offering, you just invest in a different one. And we've got some investors who they only want to invest in Victoria. We might have some really good deals in New South Wales, but they live in Victoria, they know Victoria, that's what they want to invest in, so they'll say no. Or they'll say no to something if it's a certain distance from the metropolitan area, that they're just comfortable in and that's the beauty of a contributory model. You choose security that you're investing in rather than, I suppose, in a pooled fund where you know roughly what the various investments are, but not exactly.
Definitely.
But some investors prefer pooled funds because they don't get their money back at the end. Financial planners tend to like pooled funds because there's less paperwork involved. You put their money in, and as long as you're comfortable that they've been operating for a long time and they've got your confidence, they're more than happy to just let those investments sit there for quite some time.
Yeah. And it's very interesting, both has its own pros and cons. One question I do always think about, from a developer's perspective, you have, access to X amount of funds. You have so much experience. Why not do development yourself?
Why don't we do developments?
Pays bigger return.
Yeah. Look, it's a core product we do, which is the lending side. Probably a conflict of interest. If we were both the equity developer and the investment manager funding it, we think that blurs the role.
Yes,
So if we were to do a development, it wouldn't be through Bowery Capital because that's strictly a lending business, and we like to keep
the lines.
Yeah, keep it separated, because that way, and the reason for that is we want our investors to know when if something happens, we will act in their best interest,
Of course.
not in the interest of anyone else, and
100%.
including ourselves if we were the developer. So I think
Makes total sense.
yeah, it just keeps things very
And I think
clear.
it's really fair and square as well, because I see a lot of development funds who are also developers, and they put their hand up when the deal gets presented to them and say, hey, we'll take this deal from a buyer's agent and, do the development. And then I always question as to, okay, whose sides are you playing now?
Yeah, that's not something.
That already blows the mind.
And look, there are other funds out there who do their own developments, but they tend not to fund them. They will use an external funder.
Yeah.
And
borrow them.
if that's what we would do, it just keeps things clean, and no one can accuse of any conflict of interest. Gets a bit murky when you're on both sides of a transaction.
100%. Now, of course, the development market has gone through some crazy times, right? The building cost, materials, the labor cost, the shortage, etc. How did you guys navigate through all of that sort of,
Yeah, pretty well, actually. Look, probably the toughest time was the COVID-related shortages of material, when, the price of timber went through the roof, the price of steel, and sometimes you couldn't get it at any price. It was just delays, and that causes enormous challenges for developers, because developers work on fixed price contracts. So when they agree to build a development, it's at a fixed cost. If during the time of that development the costs of inputs change, that squeezes their profit, and the reason those fixed price contracts exist is because funders like us will only fund something if we know what the cost is going to be. We can't have an open-ended blank check that will fund anything. So that did put a lot of developers under pressure, and builders under pressure.
Yeah.
And what often happened in that situation is that good developers came and said, well, yes, I might have agreed to a fixed price, that I'd pay you a fixed price, but clearly the cost has gone up, and usually they put more money in to finish the project, because no one wants a builder working off-site or walking off or not being able to complete the project because the costs have gone up. But so we got through that pretty well. It was a really tough time to be a builder. Now the heat has really come out. The input prices are still high, but they're not going up during the term of a build, which is really what caused the problem. And labour shortages were really critical. So we found in that time it was really important to choose builders who had a network of tradies who were loyal, who would come to their project. Hopefully they lived quite close, because tradies were so in demand that if they had a choice of, they'd say, I'll work on this one that's really close to me, I'm not driving across town to go to that one. It was really, really hard to get people on site, but a lot of the heat's come out of the market now. So,
and look, builders ultimately are glorified project managers, right? If you really think about it, right? A lot of what they control is basically the demand and supply, right? So,
and they're overseeing a whole network of other people who are physically doing
and so, I almost felt that it was quite unreasonable for Victorian government to basically push the builders into fixed price contracts when the prices were rising, right? I understand that everyone is trying to cap the risk, but why shove all the risk to the builders when everyone needs to share the risk, right?
Well, the negotiation is a risk-sharing arrangement, but fixed price contracts, you wouldn't really have a viable financing market.
Of course, it wasn't there. I understand. But then
without them, you probably have to fund it yourself.
Yeah. And look, I'm not a builder. I never will be a builder. We work at an arm's length with a lot of builders. But I understand the corners that the builders were pushed into, especially in Victoria, right? When you talk about New South Wales or you talk about South Australia, the government did came out and said, look, the price of rise, builders have an opportunity to basically go out there and provide some variations to the contracts because clearly it's out of their control. I've seen developers forcing the builders to build the price at what the contract was signed. And I've seen some builders taking massive hits. Developers also, default back down to the domestic builders insurance, right? So if the builder goes bust or the builder goes bankrupt, they always have a fallback cost to depend on, domestic builders insurance and say, hey, we're going to call out on that. for them to come out and finish up the project, right? So
that's right.
Yeah.
But that's all very time consuming.
of course,
And in the meantime, the interest
and
bills.
just keeps
Yeah. So, I mean, that's not an outcome that anyone
wants.
So,
100%, yeah.
The best way is
Coming,
they get together and negotiate and work out a way to complete the project. That's always the most important thing. Complete the project. That way your security
everything.
is complete and
Everyone's realized the profit, right? At least it's there, even as a residual stock. Tell us about some of the deals on the offer right now. What are you seeing in the property market and what are you guys offering?
Yeah, so there's a lot of subdivision work going on, particularly on the sort of urban fringe suburbs where developers will purchase a site and then subdivide it into 25 residential lots. That's been a really good market for us. A lot of deals, the construction deals have been, I suppose, parked because deals that were profitable 2 years ago are no longer profitable because of increasing interest rates and increasing prices of materials. So some of those are just being put aside and that they might just be sitting on the property for a while. So there's not as many deals in the market now as there was a few years ago.
Yeah.
But there's still pretty good. We're still seeing really good pipeline of deals coming to us. Yeah, and at the moment our book's probably about 30% construction, 70% non-construction, and really stays around that level.
So when you say non-construction, it's more like subdivisions.
Well, no, just what we call a passive loan, or just a land loan where you're just secured by a piece of land that perhaps is going to be a future development site.
Sure.
But the developer's bought it and they've just taken a loan for 12 months while they get their permit in place, while they get all the designs ready for their future construction.
Sure.
And then it will be a development or construction loan in future.
Sure.
But at the moment, they're just working through that.
Sure. And so usually, especially in Victoria, 12 months is not enough, for the planning exercise side of things. So how does that happen? Do you guys offer them extensions? Do you guys offer them rollover into, new loans?
It's case by case, but if we try to always take a realistic approach of how long something will take. Sometimes, a borrower will say, 6 months and I'll do A, B, C, D, and E. No, but you won't. It'll take longer than that.
Yeah.
You're going to need a 12-month loan. You might even need 15 months. If at the end of that they haven't been able to achieve or they're not ready to go to construction, we might just look at another facility, a shorter one. It really depends on the borrower and their circumstances. But we always, it's very important to have a well-defined exit strategy. So whenever we lend someone money, we need to know how they're going to pay us back. Are they going to, if it's a build, are they going to sell it? Are they going to refinance it? Are they going to lease it and then refinance it to someone else? Are they going to undertake construction? So they'll then need a construction funding, and we need to be able to assess whether that exit is feasible, because that's how we get paid. That's how investors get paid. So, having a well-defined exit is very important. That doesn't mean that when you come to it, if circumstances have changed, we can't tweak it a bit, but we want to know in advance how this ends.
Yeah. And how closely do you guys work with developers? Because, of course, everything that you think can go wrong will go wrong with every development, right?
Yeah, it depends. I mean, on the level of experience, there are some people you just goes like clockwork. You don't have to worry. You just they just want the funds advanced at the right time, and we just make sure that all the milestones are ticked off. There are others, and if we feel someone's maybe not as experienced, we will ask them or insist that they appoint an independent project manager to oversee the project at their expense. Someone we appoint, but is included in the cost of the development, and that way we've got our guy on the project who's making sure it's all going in the right direction. So it just depends on how experienced and how technical the job is. But, most of our developers have done many projects of a similar nature. So, and they're pretty good at it. While there are some, and sometimes you hear about this sort of cowboy element to property development,
Yeah.
There's also a lot of very, very professional, well-run corporate type developers who are an absolute delight to work with.
Where do people find you, if they want to reach out to you, be it a developer reaching out to you for finance or...
The best starting point is our website, bowerycapital.com. So if you're considering investing, I think private debt is something you could consider. It's a really compelling mix of risk and return. You've got the mortgage-backed security, which gives you, great risk profile with a return that is typically better than you can get, say, from a listed equities or yield or through direct property ownership. So more and more people are looking at private credit as part of their portfolios.
Thank you very much, Matt. And for viewers and listeners, if you have any stories to share in relation to, private debt, in relation to your own development, in relation to your experience with private debt, or as an investor, investing for other investments in private debt, please share your stories in the comments below. Do check out our page. Thank you for listening to us today. Take care, stay safe, keep smiling, keep investing. This is Matt and Moz checking out. Adios.